The value of surrendered annuity policies among U.S. life annuity writers has increased 19% through the first half of 2024, compared with the same prior year period, according to a new AM Best report. Yet premium growth has held steady at 21% through the same time frame, with individual annuity premium notching its 14th consecutive quarter of year-over-year growth. I'm John Weber for AM Best TV. Joining us now to discuss this report are Kaitlin Piasecki, Industry Research Analyst, and Jason Hopper, Associate Director, Industry Research and Analytics with AM Best. Jason, starting with you, is there potential for an imbalance here that could affect life annuity writers?
Sure, John. Thanks. So I'll start by saying that the annuity market is highly competitive with many new entrants, right? Some are newer companies with cleaner portfolios. They may not have the burden of old legacy systems and the potential costs associated to upgrade those. And both those efficiencies combined could potentially lead to the company being able to offer higher and more competitive crediting rates on their products. You also have companies backed by private equity or asset managers also entering the annuity market. And those sorts of companies could potentially leverage their sophisticated investment expertise to, again, offer competitive and potentially higher crediting rates on products. But one point to note is insurers are less concerned about surrenders once their policy leaves the surrender charge period, right? And the reason for that is because the assets that were purchased to back those liabilities were matched to them and have also likely matured. But one thing that we do want to note is ample liquidity, and keeping those customers in-house is obviously critical.
Kaitlin, is it safe to assume that interest rates have played some role here?
Absolutely. So there's been some disintermediation risk where policyholders are surrendering their current policies in favor of other policies or assets that are going to offer them better rates. Rates are still nearly double now than what they were a few years back. But with the recent rate cut announced, consumers may feel pressured into locking in those rates with other policies. Also, when consumers move into a new contract, they are going to restart that surrender charge period over again. So that's going to help companies lock in that business. We've also seen an increase in the share of reserves with market value adjustments attached to their surrender charges, and that's going to disincentivize future surrenders.
Okay, that being the case, could this issue affect life annuity writers disproportionately, depending on their scale?
So it's important to retain the business that gets surrendered and have that premium coming in rather than lose that business to a competitor. On a cash flow basis, when looking at the ratio of premium cash flow coming in to benefit cash flow going out, there's been a steeper downward trend for companies that are within our individual annuity composite when compared to individual life and multiple lines. And particularly smaller sized companies within the individual annuity composite have seen the greatest deterioration.
Jason, any concerns, and what are you keeping an eye on as we move forward?
Sure. So general enterprise risk management practices are obviously very critical, specifically stress testing in this sort of environment, as well as more frequent repricing of crediting rates and managing that on an ongoing basis. Those things are going to take on greater importance to help mitigate risk, right? Still, assumptions used in cash flow testing could be volatile with the movement in interest rates, which could lead to additional reserves or potentially a little crunch on capital, right? But either way, with rates recently bumped down, we'll see if these trends continue, and something we'll continue to monitor.
Thanks, Jason. Kaitlin.
Thanks, John.
That was Jason Hopper and Kaitlin Piasecki. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.